There's a company that's been drilling through oil busts, geopolitical crises, and commodity collapses since 1919. And this morning it reported a first quarter that beat expectations on both revenue and earnings. The stock is up. The CEO is talking about white space disappearing. And if you know anything about oilfield services, that phrase should get your attention. I'm Hudson Thomas.
I'm Lana Chen. This is Charged Alpha, and today we're breaking down Halliburton, ticker HAL, after the company's Q1 2026 earnings hit this morning.
Over a century in the ground, 48,000 employees, operations in more than 70 countries. And today, we find out what it all adds up to. In a world where oil prices are volatile, OPEC is flexing, and energy companies everywhere are watching their budgets very carefully. Let's orient people. Halliburton is one of the world's largest oilfield services companies, second only to SLB, formerly known as Schlumberger. But what does that actually mean? Oil doesn't just come out of the ground on its own.
Right, Halliburton doesn't own oil. It doesn't drill wells for its own account. What it does is provide the picks and shovels, the equipment, the technology, the expertise, the chemicals that energy companies need to find, drill, complete, and produce oil and gas from the earth.
The company was founded in 1919 by Earl Halliburton in Wilson, Oklahoma. He started with a single horse-drawn wagon and a contract to use oil well cementing techniques in that nascent industry. More than 100 years later, the company is headquartered in Houston, Texas, and operates 14 product service lines across 2 business segments.
Those 2 segments are everything here. The first is completion and production. They call it C&P. That's about 58% of revenue. It covers hydraulic fracturing, cementing, artificial lift, production chemicals. It's heavily weighted toward North America. The second is drilling and evaluation, D&E, which is 42% of revenue and much more international. That covers drilling fluid systems, wireline, testing and evaluation, and project management.
The mode is built on 2 things, scale and technology. The Zeus electric frac fleet, the iEnergy digital platform, and the Octave AutoFrac autonomous fracturing system are all Halliburton innovations. With 14 product service lines, the company can offer integrated solutions that smaller competitors simply cannot. And once you've trained your crews and certified your equipment on a HAL system, switching to a competitor comes with real cost.
The why now is the Q1 beat this morning. Revenue of $5.4 billion against estimates of $5.3 billion, and EPS of 55 cents against estimates of 49 cents. But the more interesting story is what's happening in the market underneath those numbers. International grew 3% while North America declined 4%. And management's comments on capacity tightening are worth unpacking.
Let me tell you about Jeff Miller, because running Halliburton isn't just about managing a big company. It's about knowing oil in your bones.
He's chairman, president, and CEO, all 3. He's been CEO since 2017, added chairman in January 2019, so 9 years in the seat.
And the backstory is genuinely interesting. Jeff Miller was born in Dallas in 1964. He briefly competed in professional rodeo roping, yes, rodeo, before earning an MBA from Texas A&M. He then became a CPA at Arthur Andersen. Not exactly the typical oilfield resume.
But he joined Halliburton in 1997 and spent years in the field: Venezuela, Angola, Indonesia, Dubai. Real operating experience in real markets. He moved to Houston in 2010, became EVP and Chief Operating Officer, was named President in 2014 and CEO in 2017.
And his tenure has been defined by 2 things, technology investment and capital discipline. Zeus electric frac, iEnergy, Octave AutoFrac. These aren't just marketing terms, they're real competitive differentiators that Miller championed internally. He's also been consistent on capital returns, which we'll get to when Lana walks through the financials.
His reputation on the earnings call is one of straight talk. He said this morning that he's pleased with Q1, that international is performing well, and that North America is showing early signs of a recovery. He also didn't sugarcoat the Middle East headwind coming in Q2. That credibility matters when you're managing investor expectations in a cyclical industry. All right, let's get into it. Price as of today is $38.46. Market cap is $32.2 billion.
So mid-cap for the S&P 500.
On the larger end of mid-cap, yes. Now on valuation, the trailing PE is 21 times on a GAAP basis. But I want to flag that the trailing number is distorted. Halliburton had a charge-heavy Q3 2025 with very depressed reported earnings. The more relevant number is the forward PE of 17.5 times based on full year 2026 estimates of $2.20 per share. Price to sales is 1.45 times. Price to book is 2.97 times. EV to EBITDA is approximately 9.8 times.
So it's not expensive by energy sector standards.
It's not. In fact, it trades at a discount to SLB on both price to sales and EV to EBITDA. Now, on revenue, TTM revenue is $22.2 billion. But quarterly revenue has been remarkably flat. We've been in the $5.4 to $5.8 billion range for 8 consecutive quarters. Year-over-year growth in Q1 was essentially zero, down 0.3%.
That's a revenue plateau.
That's the right word. Now, on the Q1 2026 beat specifically, revenue was $5.402 billion, against estimates of $5.305 billion. That's a 1.8% beat. EPS came in at 55 cents against estimates of 49 cents, a 12.2% beat on the bottom line. Adjusted EBITDA was $974 million against estimates of $944 million.
What drove the beat?
2 things. First, international revenue grew 3% year over year, led by Latin America, and the early contribution from the YPF Argentina Zeus electric frac deployment. Second, the drilling and evaluation segment showed better than expected margins internationally. North America was the soft spot, down 4% year over year, but the street had already baked in weakness there.
Now let's talk margins, because this is where Q1 2026 looks meaningfully better than the TTM picture.
Correct. On a Q1 2026 basis, gross margin was 14.6%, operating margin was 12.6%, net margin was 8.5%. Those are solid numbers for this industry. The TTM figures are a bit lower because Q3 2025 included charges that depressed the reported results. On a run rate basis, the business is in reasonable shape.
Cash flow?
TTM operating cash flow is $2,822 million. TTM free cash flow is $1,678 million. Q1 alone produced $273 million in operating cash flow and $81 million in free cash flow. Q1 is typically the weakest quarter seasonally for HAL, so this is in line. The company guided full year 2026 free cash flow comfortably above $2 billion at current activity levels.
Balance sheet.
This is where I'd add a watchful note. Cash on hand is $2,003 million. Total debt is $8,081 million. Net debt is $6,078 million. Debt to equity is 0.75 times. That's a leverage level that's manageable in a strong environment, but worth monitoring in a downturn. Overall, Halliburton's financial health is watchful. The business generates solid cash flow, the earnings are there, but the balance sheet has meaningful leverage that limits flexibility compared to SLB or Baker Hughes.
What's the consensus? Because I know the analyst community is fairly split on this one.
They are. Of 18 analysts covering Halliburton, 9 have a buy or equivalent. Morgan Stanley has an overweight, Citigroup a buy, Susquehanna a positive. 8 have a hold or neutral, that's Barclays at equal weight, Piper Sandler neutral, BMO Market Perform UBS neutral. 1 is a sell.
So a modest buy majority.
Moderate buy, yes. The average price target as of post-earnings is around $40, about 4% above today's price. The range runs from $28 on the low end to $46 on the high end. Morgan Stanley is the most bullish at $46.
Worth noting that before this morning's results, the consensus target was actually closer to 35, which was below where the stock was trading. So analysts are catching up.
That's the right framing. The stock ran ahead of consensus during the bounce from the 52-week lows. Q1's beat will likely prompt several target upgrades over the next few days.
And on earnings this morning, anything specific from the call that moved the needle?
2 things. Jeff Miller's line that white space for Q2 is all but gone was the most bullish comment. It means HAL's North America frac crews are essentially booked up for the second quarter, which suggests demand is firming earlier than expected. But he also acknowledged the Middle East headwind is getting bigger in Q2, 7 to 9 cents per share impact, up from 2 to 3 cents in Q1. So it's not a clean beat. There are genuine crosscurrents.
Let's lay it out, starting with the bull case.
Go ahead.
Bull case number 1, international is the engine. 60% of Halliburton's revenue now comes from international markets. And international is growing, up 3% year over year in Q1, while North America declined. The YPF Argentina contract is a multi-billion-dollar win that marks the first international deployment of Zeus electric fracturing technology. If that technology gains traction with national oil companies globally, it's a meaningful growth avenue. Bull 2. North America is tightening. When a CEO of an oilfield services company says white space for next quarter is essentially gone, that's an early indicator of pricing power returning. If activity levels firm through the spring and summer, HAL's C&P segment margins should inflect higher. The frac spread count is already showing some stabilization. 3. Technology differentiation is widening the moat. Zeus electric frac isn't just a greener alternative, it's a superior total cost solution. Lower fuel costs, higher reliability, better automation through Octave AutoFrac. The customers who adopted Zeus early are already reporting efficiency gains. That creates loyalty and repeat contracts. 4. Capital returns are a pillar. Halliburton returned over $1.6 billion to shareholders in 2025 through buybacks and dividends. With TTM free cash flow of $1.7 billion and a clear management commitment to returns, shareholders are getting paid to wait for the energy cycle to turn. 5. The valuation is undemanding. At 17.5 times forward earnings and 1.45 times revenue, HAL is at a discount to its own history and to SLB. In prior energy cycle recoveries, HAL has seen both earnings growth and multiple expansion simultaneously. The combination can produce outsized returns.
Reasonable bull case. Now the bears have something to say too. Bear thesis 1, oil price is the master variable. Brent crude is hovering near $65 per barrel, and OPEC is increasing output. North American E&P operators respond fast to lower oil prices. They cut rigs and frac crews almost immediately. If oil falls below $60, HAL's revenue growth story reverses. 2. The Middle East headwind is getting worse, not better. Q2 guidance of 7 to 9 cents per share, up from 2 to 3 in Q1, means the regional conflict is materializing into bigger earnings impact. Management admitted the path to recovery in that region remains unclear. 3. 8 quarters of flat revenue is a warning sign. From Q2 to 2024 to Q1 to 2026, HAL's quarterly revenue has stayed in a tight band. If you're paying 21 times trailing earnings for a company with no revenue growth, you're relying entirely on the next upcycle, and timing cycles is hard. 4. The stock has outrun the analyst consensus. At $38.46, HAL trades above the average Wall Street price target heading into today. The market has priced in recovery before the recovery has actually materialized in the numbers. 5. Balance sheet limits the playbook. $6 billion in net debt means Halliburton can't be as aggressive on M&A, technology investment, or buybacks as SLB, which has a much cleaner balance sheet. In a prolonged soft market, the debt servicing requirement is a drag.
So the bulls need the energy cycle to cooperate. The bears think it might not. Let's stack HAL up against the peer group. Who are the natural comparisons?
3. SLB, Baker Hughes, and Technip FMC. Together, these 4 companies define the large-cap oilfield services landscape.
First,
SLB is the global leader. Market cap of $61 billion, nearly double Halliburton. Price to sales of 1.8 times versus HAL's 1.45. PE of 16 times. SLB commands the premium because it's more internationally diversified, has a larger digital and data services platform, and has less North America exposure. HAL is actually the cheaper stock on price to sales, which is one argument the bulls make.
Baker Hughes.
BKR has a market cap of $41 billion, PS of 1.55 times, PE of 19.8 times. Baker Hughes has a more diversified business model. It has an industrial energy to technology segment covering gas turbines and LNG equipment, which gives it some insulation from oil price cyclicality. HAL is cheaper on price to sales but perceived as having more cyclical risk.
And Technip FMC?
FTI is the subsea specialist. Market cap 28.7 billion, PS of 2.1 times, PE of 24.5 times. It commands a premium because deepwater project backlogs are long duration and less sensitive to short-term oil price swings. It's a different risk profile than HAL.
The takeaway being that HAL is the most discounted on revenue multiple, but also the most exposed to near-term North America volatility.
That's the core trade-off. You're getting a cheaper multiple in exchange for taking more cyclical risk.
What's the options market saying?
I4 is at the 45th percentile. Post-earnings cooldown from elevated pre-report levels. The put-to-call ratio is 0.92, which reflects a slight defensive lean from options traders. Not panicked, but cautious. That put-call reading is consistent with investors hedging oil price risk rather than making directional bets.
Where's the positioning?
The $35 puts carry the heaviest open interest. The market seems to be treating 35 as a key near-term support level. On the upside, the $42 calls have meaningful open interest, suggesting some traders are positioned for a continued recovery toward the 52-week high range. Given the stock opened around 38, there's clearly an asymmetric positioning, more protection below than conviction above. As always, options tell you where money is positioned, not where the stock is going. But the put-heavy skew around 35 is worth keeping in mind.
What are insiders doing?
Modest selling. 3 sell transactions in the past 6 months, no buys. Net share reduction of about 45,000 shares. This is consistent with normal executive compensation vesting. No unusual clustering or unusually large transactions that would signal insider concern. The absence of insider buying is also not alarming, given the stock nearly doubled from its 52-week lows, so its executives who want to build exposure already had the opportunity at lower prices.
Nothing alarming, but nothing particularly bullish either.
That's the right read.
If you're tracking Halliburton from here, what are the critical signposts?
4 things. Number 1, the Baker Hughes weekly rig count, released every Friday. North American rig count is the single best real-time indicator of HAL's C&P revenue trajectory. Watch whether that number stabilizes or continues declining. 2, the North America frac spread count. This is more specific to HAL's completion business. If the frac spread count moves higher through Q2, the white space gone narrative gets confirmation. If it doesn't, it gets questioned. 3, oil price direction. Brent crude at $60 is a warning level for North American E&P capex budgets. Brent above 70 is the unlock. Watch weekly inventory data, OPEC meeting outcomes, and demand readings from China. 4, the Middle East recovery timeline. Management said Q2 impact is 7 to 9 cents per share, but they also said the timing of recovery is unclear. If Q3 gets the same headwind, the earnings picture for the full year gets meaningfully weaker.
The catalyst for upside, a Q2 earnings call in July that confirms NA tightening, oil prices recovering above 70, and any incremental international technology contract wins like the YPF Argentina deal. All right, bottom line, what's the Halliburton story in 1 minute?
Halliburton is a century-old oilfield services company navigating a complex moment. Q1 2026 showed the business in solid shape, international growing, technology winning new contracts, margins holding. The beat this morning was genuine, but the near-term picture is mixed. North America is tightening but hasn't yet turned. The Middle East conflict is creating a real near-term earnings headwind, and revenue has been essentially flat for 2 years.
The long thesis is that we're in the early innings of an international services recovery, that HAL's technology differentiation, specifically Zeus Electric Frac, gives it an edge in the next upcycle, and that the valuation is cheap enough relative to the cycle optionality to justify ownership. The risk to that thesis is oil staying soft.
The one metric to watch above all others, global rig count, and specifically the North American frac spread count. Every uptick there translates almost directly into C&P revenue and margin for Halliburton. Watch that number every Friday like a heartbeat monitor for the stock.
We always close with a quote. For Halliburton, I went with Albert Einstein. In the middle of every difficulty lies opportunity. And I think that is an almost unfairly perfect description of what oilfield services companies deal with every day. Commodity cycles, geopolitical disruptions, technological disruption, all of it difficulty, and all of it potential opportunity if you're positioned right.
Einstein wasn't thinking about hydraulic fracturing when he wrote that, but I'll take it.
That's going to do it for this episode of Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.